Well, here we are, another Tuesday evening. And yes, they come around every week, but it feels like every other day at the moment. It's so much going on. I'll put the pre-show on just for a moment. Hope everybody's well. We're just counting down to the 8 p.m. start. And as normal, of course, the doggies are here and looking fairly relaxed. They've had their meal and a bit of a walk, so hopefully they'll be quiet, although the bins will be collected shortly. And of course, as normal, here's the studio. Damien is over there. He's going to join us very, very shortly, and we're all set up, ready to run the show as normal, I think. Hopefully, everything's working. As with all of these things, I keep my fingers and toes crossed as everything starts up. But today, so far, no technical failures, I think. So that's pretty good. So let's keep it going. Anyway, we're going to have a fascinating conversation today about the markets and what's been going on, and of course, a lot to talk about from the Straits of Hormuz through to AI, through to energy and chips. So plenty of things to touch on. Anyway, let's take the pre-show off, and I'll start the show properly back in just a moment. Well, good evening. Welcome to this live stream on the 14th of July, 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you very much for taking time out of your busy Tuesday evening to spend it with us. Really appreciate it. And hopefully it'll be worth your while tonight, because we're going to talk specifically about the markets and market dynamics and some of the things that are going on below the waterline, which I think will be very interesting and very informative. Before I do that, let me just remind you that we don't provide specific financial advice or even legal advice or property advice. It's a general conversation only. We moderate the chat, but do feel free to throw your questions and comments in as we go. If you've got specific things that you would like us to address, if you use that Walk the World DFA, that'll get into my queue and I can bring it in. I've enabled Super Chat, which means you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate all those supporters via Super Chat, Patreon, and PayPal. Makes a big difference, because we don't do this for profit. We do this because we think there's a very important conversation to be had, and your support really makes a tremendous difference. So thank you very much for all those supporters for those various channels. Right, let me bring Damien straight in. Damien, back from a holiday, I think, and back into it, boots and all.
Yep, absolutely. Look, it's got to keep an eye on markets while you're away. So it's certainly been interesting times. It's luckily a lot of it's been a replay of what we've seen over the last couple of months anyway. It seems like we're in this interminable. Is the war on? Is it off? Is it on? Is it off? Another peace deal. Another one torn up. Bond yields higher. What else? Inflation. And big ones, earnings. Yeah, that's said. I think I've said, as I said last time round. The real key to this is working out, is this, it's not a question about is this a bubble in terms of a stock market bubble. Is this an earnings bubble? Because actually the stock market's cheaper than it's been, because the earnings keep going up so fast. And so now it's a question about saying, well, how sustainable are these earnings? And we'll talk a bit more in detail, but the short version for me is that the stuff we're seeing at the moment in terms of earnings growth is from some very cyclical companies that do historically go through these massive cycles. And so, whereas the earnings from some of the other guys, some of the AI sort of focused ones, I'm like, yeah, okay, I can see where this earnings can last for a long time, and they've got some moats and other stuff going on. Some of the stuff we're seeing today, particularly from the semiconductors, is like, man, these things are just cyclical type companies that just happen, all the time. Mm-hmm. And so, there's less of I think there's less behind it. When it does finish, that'll finish quickly. It's just a question of, how long until that happens.
Yeah, which is why I separate the AI story from the chip story, right? And we'll get into that in more detail, because it's really important to understand that they are not necessarily the same, although one supports the other, at least for now.
Mm.
But we should just start, I think, with the latest from the Straits of Hormuz, because, of course, we had the Trump truth or retruth
Yes.
or whatever you want to call it. I don't know whether truth or a lie, whatever. Anyway, we're now blocking the straits. We're going to put the Iranian blockade back in. We're going to charge 20% on all cargo shipped, and the process and formation will begin immediately. Now, to my mind, this is just the latest in the shuffle of on-off diplomacy, but not much diplomacy. But the truth is, of course, that we are now in a rather unfortunate position where the strategic petroleum reserve in the US is quite close to the lowest it's been for a long, long time. We know that
Mm.
China ran down some of their reserves, but they can't go on doing that ad infinitum. And meantime, the rest of the world is now scratching its head thinking, well, what does it mean for energy? What does it mean for some of the petroleum fertilizers? In other words, is this going to go on and on and on? And if it does, what are the implications? Well, to my mind, inflation. The inflationary pulse that this is going to create could be significant and very long term now. So this is a very important development and a worrying development because they can't see a way out of it.
Yeah, that's right. And the thought that I mean, we did. I'm sure we spoke earlier in the piece about this, saying, look, is there some sort of deal to be done where there's basically a payment, a toll payment to be paid, and the US will split it with Iran or something like that. And it seems like that's what Trump's trying to line up. I would say it would be my guess in terms of this. Is there a victory he claims where it's not 20%, but that's the starting bid just to to move it, and everyone, oh, no, you can't possibly do that. 20% is far too much to do. That's a crazy number. And it's like, well, okay, well, so maybe they're charging $2 or $3 million a ship, and some of it's ending up with the US, and yeah, whatever. And then they can claim it's a victory. I don't know. It's who knows. It's I guess the main point is that I guess we made and we've made several times about this is there's plenty of peace declarations to come, and then there'll be something else, and then there'll be another peace declaration and another one, and that doing these types of deals are complicated, and you need lots of diplomacy, and you need lots of people who have got attention to detail, and none of those fit into Trump's sort of modus. He's happy to do the big picture, shake a hand, and we're done. But the actual getting the deal done is unlikely to happen in the short term. And we've just seen that pretty much regardless of whatever you're talking about. If it's Nvidia is a great example. The number of times it's been solved that he's going to take us some sort of extra tax, and they're going to sell chips to China, and it just doesn't go through because once he's made the announcement, he moves on, and then everyone wants to, okay, which ones can we sell, which ones can't we sell, what are all the things can't get his attention. It's shifted off, and I just think that's the Straits of Hormuz. It's going to be back and forth for the foreseeable future.
Yeah, and looking at the energy markets, of course, the implications are that this is the Brent is up, not quite as high as where it was worst, but up to 87 now, which is, significantly above where it was before all of this started. And of course, the natural gas, this is actually the Dutch natural gas, is also quite up. In fact, I think the natural gas story for Europe in particular is a really significant pressure point now, because of course we're coming into the later part of the year. The reserves that they would normally have at this time of the year aren't there. They're going to be clawing their way into trying to find other sources, which is going to put more upward pressure on prices. And in fact, in the UK, we already saw energy prices up, which means consumers had to pay a lot more because there's a lag between what the prices are and the market prices. And I guess the other point it's worth highlighting is that the energy markets are recognizing that there has been something of a reconfiguration of energy flows around the globe. So obviously the US is still pushing out a lot of stuff, but there is still a capacity constraint and a capacity problem that isn't being solved at the moment. So the longer this goes on, the more dire the prospect is. And of course, in Australia, I think they came out and said, well, we've got so many weeks of jet fuel and so many weeks of, back to the old mantra again, you know, don't panic yet sort of thing.
Mm. Yeah, yeah. And look, these things are always so that it's interesting in that, if nobody sometimes in these things, if nobody panics, then everything's fine, you get through. But if everyone else panics but you don't, then you're the one who's going to miss out, and so yeah, it's you can sort of end up in these scenarios where um uh where companies sort of looking after their own purposes is sort of what ends up driving a lot of the problems. And we certainly saw that in the earlier stages, is that there seemed to be a lot of inventory building by companies themselves, which is sort of driving a lot of that first round of price increases. And now we're at that point about saying, well, I don't think companies are giving up those inventories.
Mm.
If the whole thing was done, then you get a bit of so I guess in this sense, the price might have naturally gone from 100 to, sorry, from 80 to $90, $80, $90, but it goes up to 100 because everyone's trying to get extra inventories. And then on the downside, maybe it doesn't fall at 50 or 60, it sort of shoots to 40 because everyone's trying to unwind their inventories when they think the whole thing's over. But I do think the inventory building that's being done, is years away from being undone. I think, and there's government inventories that need to be filled. And so, yeah, I think they're looking at higher prices for a considerable period of time. And as you said, if it just means that there's a reconfiguration of where stuff's coming from, what does that mean? Well, it generally means a few more dollars in cost. For per barrel or per
Mm.
BCF or whatever it is you're buying, is that it's probably coming from further away, or by a method that's more expensive, shipped rather than by pipeline or whatever it is. And so, yeah, just more to that inflation story.
Yeah, and the point there is that the inflationary story is definitely higher than where it was. In Australia, inflation has been high even before the latest CGT changes and other bits and bobs sort of came over the top and started messing with other things. So there was an inflationary pressure building, which is why the RBA lifted rates 3 times, and Westpac is still saying another one or maybe two. In the UK, they were expecting rates to be cut before the Straits of Hormuz problem. Now they're talking about maybe one rate hike. In the US, Walsh came in, the new Fed chair, and said, we haven't got inflation under control over the last 6 years. We are going to get it under control. And so the markets interpreted that as more likelihood of a rise in rates. And I know that there's some inflation reporting coming over the next few days, which may change that slightly, but probably with what's happening in Hormuz, we should expect higher costs running through there. So all of this is a higher inflation environment, bond yields, of course, following. And yet the markets, I mean, if you look at the S&P 500, right, this is the latest S&P 500, they're saying nothing to see here. I don't fully get the disconnect between the energy market and the broader market, but I believe it's probably masked by the whole AI story, isn't it?
Yeah, it's earnings. It's
Yep.
earnings is the difference. And let me. Am I showing the earnings chart? I'm pretty sure I am. Sorry, let me pop that up.
Yep. I'll show it now.
Yep.
There you go.
Yeah. So this is the one that I've come back to a few times. The red line's the one to focus on. The blue lines are each individual year, and the red line is a 12-month forward sort of rolling number that takes a little bit more. So at the moment this is sort of half 2026 and half 2027 numbers. And then next month it'll be, or at the end of this month, in another 2 weeks' time, it'll be 5 months of 2026 and 7 months of 2027, and so it sort of just keeps rolling forward. Now, why I've picked this period to show is that you can see back at the start is of this chart is 2010-ish, 2008, 2009 to 2010, as we're coming out of the financial crisis. And you can see earnings took a big tumble into the financial crisis, and then they're rising, for the next couple of years. And you can see the sort of trajectory we saw earnings on. And then you go, okay, now we come out of COVID, and earnings bounced back much, much faster. So that first one, and then that line sort of, at 45 plus degrees coming out of that. Now, when you go to the end of this line where we are at the moment, like that's just on a like we're it's accelerating faster than any of these recoveries from massive earnings falls, and uh, how sustainable are those earnings? Well, it's well, we won't be on that same trajectory, I guess, for forever. And the question is, when you look at these earnings and it's factoring in 25% growth for this year and 18% growth for next year. Well, if 18% growth for next year goes to 8% growth or something like that, something more normal that you see from the market, then you not only get a 10% fall in terms of the expected earnings, and so probably markets fall 10%, but all of a sudden you don't really want to pay that much for markets. If markets are growing in the top, at the moment we're growing in the top 1 or 2% of what we've seen ever. In terms of the earnings forecasts. Okay, so and you can buy the market at sort of the 80th percentile or 75th or 80th percentile of how expensive it is. Because you're saying, okay, well, I'm buying some of the best growth we've ever seen, and I'm paying a bit more for it, but I'm not paying dramatically more. Whereas if it goes from that top 1% of earnings to back to the 50th percentile even is now all of a sudden, well, do I want to pay, for average earnings, do I want to pay above average multiples? And that's where, this thing can reverse really quickly. So what I'm saying is, we really need to know what's going on in these numbers. Like you need to be on top of, well, which of the sectors that's doing this? Where's the growth coming from? Is it high quality growth? Is it low quality growth? The consumer seems pretty weak, so it just doesn't make sense to a lot of people who are getting this type of growth. And there's a couple of I can paint some reasonable bull stories about why this will keep on going. Do I believe them? No, I'm not. I'm certainly not I'm not wedded to that view. I think you need to be open to the fact that it might come about. I think there's a lot of cyclical companies in particular at the moment whose earnings do go up and down quite dramatically over the cycle, who look like they're in a super cycle. And so is the super cycle going to finish in 2 months? Is it going to finish in 9 months? Is it going to finish in 12 months? Like that's, could it last for 2 or 3 years? It's really that's the key story, because if the earnings stop growing, this market doesn't have, there's enough going on that you could see this market falling. If the earnings keep going up, then it's hard to see this market, taking a real tumble while you've got such strong earnings growth.
But isn't the question dispersions of earnings across the market? Because there are not all firms enjoying the earnings boom, right? There are particular areas of the market where there have been significant earnings. Some of those are probably areas where they're relatively short, sharp, and then perhaps coming back to norm. Others might be more likely to continue, but some of the consumer-related ones, some of those who are actually more reliant on energy, I'm thinking of some of the travel, for example, they're not really doing anything like as well.
No, they're not. And the reason why the markets are still staying high, though, is because these stocks are no longer a big part of the market.
Yes.
They're sort of, the really big stocks are, there's a stock, Micron, which I'm sure I've spoken about on this several times. There's this company that does memory. They're basically one of three big players: Samsung, SK Hynix, and Micron. And Micron's pretty much the third best of them at the moment, anyway. And valuation's well over $1 trillion now. Like for this company that most people have never heard of, and you can just see that run up in share price. There is it 10 times or something like that?
Yeah.
It's just, and this is a company which routinely loses money. And I would say, like, so over the last 30 years, you pretty much every 5 years they've had a period where they've lost money. They just sort of their earnings go up and up, and then they all come down. And the reason why is these guys make such big factories nowadays that they all sit there with these high prices. And let me take a current situation out of pretend the AI boom's not going on. Let's talk about the last couple of cycles. They all sit there, prices start rising. They're all all three of them, they're all sitting there. And then one of them goes, you know what, I'm building a new factory. and it's going to do 5% of world demand or something like that. And then the other two go, well, I'm not going to let that guy build the factory and take away all the market share. So I'm going to go build a new factory as well. And they all build a new factory. And next thing, the market's flooded with memory, and the prices come flying down, and they all lose money, or certainly Micron loses money, and then they go back through the next cycle, and off they go again. And so that's just like a 3-4 year period, and that just happens over and over again. What's different today is that we have this mega boom going on in terms of AI spend, and the earnings are just off the chart in terms of this. I've got the Philly. Sorry, it's called the SOX index. It's a semiconductor index. And so just showing the earnings in blue, that it's sort of, how they changed over the last year, and it's sort of looking at coming in at, 200 million. Oh, sorry, yeah, 200 million in terms of earnings. And then the next year is looking like it's going to be, 500 million, and then 600 million. And I think we're talking about 800 million now for 2028. And so the earnings have just, you're looking at four times the earnings for this one sector over a course of 2 or 3 years. So the earnings are just ballooned out of this. There's a stock. Which one is it? It's SanDisk. I don't know if you've got that
Yeah.
on your thing. So they were spun out of Western Digital recently, and their profit for this year is looking like it's going to be higher than what the market cap was when it was spun out 12 months ago. And so it's just this thing's gone, literally making more in profit than what the company was worth, less than 12 months ago when it was, jettisoned by Western Digital. And that one's probably up 1,000% or something like that as well, I think, in terms
Yep.
of numbers. So the earnings are there, and what's happening though is that they're getting underwritten. So ordinarily, these guys build a factory and they sell what they can. That's nature. And so what they've done is, because now they're not dealing as much with a whole bunch of smaller, diversified people buying this. Some people buying it for car chips and some people buying it for computers, and different, Dell and all these other ones all buying it, and just sort of going, well, they'll pay whatever. You make your chips and see if you can sell them to us, is basically the deal. Whereas what's been happening now is these big data centers are going back to these guys and going, well, we really, really need these chips. We'll underwrite them at a certain level. Well, we need you to build a new factory. And they're like, okay, well, I'll build a new factory, but you need to underwrite them at a certain level. So their earnings quality is probably a bit better than it used to be. I have no doubt that there's Chinese factories that will do exactly what they did with all the iron ore guys and the gas guys. Yes, it's a guarantee until prices fall, and then it's not. But a lot of the Microsofts and Googles and all that have underwritten these. So that's one part. And the other part is, these factories aren't coming on this year. Like, they're not coming on until next year or the year after. And so there is a shortage. There's a genuine shortage out there of memory and a whole bunch of other things that sort of go into the data centers. And we've got, 12 to 18 months worth of sort of forward looking, where big companies are making contracts with these guys to make this stuff. These guys haven't finished the factories that are going to do it. Maybe the factories they're building will just handle the amount that's sort of booked in at the moment. Yeah, look, it's, could this be such a super cycle that extends for another 2 or 3 years after that? Yeah, maybe. I don't look at these companies as having like some sort of magic, or such a huge technological advantage over their competitors, as they can continue to charge premium prices forever. Like, these guys are genuinely happy to make this stuff and sell it at a quarter of the price they're going to be selling it in a couple of years' time. And so when you've got enough of these companies out, 3 or 4 competitors out there, they will build enough factories eventually to bring prices back down again. It's just when. Because if, it might be 3 years' time, but if we get great earnings growth for the next 18 months, markets aren't going to know whether at that point, is it 18 months forward, or is it, 5 years forward. So I think there's it's not high quality earnings that we're seeing from that sector, at least. but it does look like it's higher quality than it used to be, and maybe it's going to last a bit longer than it usually does. This could be a much bigger cycle.
Well,
And the other thing,
just on that, SK Hynix, of course, which is a Korean stock, had a very interesting run up, but has since dropped quite significantly, and it's a very large proportion of the South Korean market, the Kospi, right? And because of that, the South Korean market has been up and down like a yo-yo, massively up from 2025, but now dropping down significantly. They also, SK Hynix, did some ADRs, in the US end of last week and was oversubscribed significantly. And it highlights the other issue here, which is that the funding needs from all of these players, and you can add in the AI players.
Yep.
Everybody is now needing to try and grab capital to be able to actually fund the ongoing investment, whether it's making chips or AI, et cetera, et cetera. And the reason I highlight that is twofold. One, the demand for capital is shooting through the roof on the back of all this. That is inflationary in itself, and that puts the price of money up, which is one of the reasons why I think bond yields are going to stay high for a lot longer than a lot of people think. And it's inflationary. And I was interested to see that Walsh, when he was making his comments recently, highlighted not just the inflationary impulses coming out of the Straits of Hormuz, but the inflationary pressures from this AI super cycle that we're in at the moment, and the fact that this is going to actually be something else that needs to be navigated when it comes to trying to keep the economic balances in train.
Yep. I wrote down 4 different things there we need to talk about. This is going to take a while. Before we get on to the other sectors that are booming, because there are actually other sectors, and energy is one of those sectors where earnings are booming because of this whole thing. Anyway, the first one, and it's slightly off topic, but it is related, is that so SK Hynix is there, but Samsung as well, which is basically doing, exposed to very, very similar things. Yes, they've got phones and other stuff that go into it, but they're also one of these massive memory manufacturers. And South Korean as well. And so if you are investing in an emerging markets fund, at the moment, you're basically getting Samsung, SK Hynix, TSMC, which is the Taiwanese one, the 3 biggest stocks making up a massive proportion of your index. And so if you're thinking, oh, let me buy emerging markets because I'd love some exposure to the middle class in Brazil or India or something like that as they grow and they do all these things, and you're not getting that. You're getting a tech exposure. You're getting the same exposure you're getting on the Nasdaq. And so it's the emerging markets. You just need to be careful about what you're getting because and there's arguments out there. Some places, some indexes don't treat South Korea as part of the emerging markets, and some do. And so depending upon who you get, all of a sudden the most important stocks in your universe are stocks that are basically are basically semiconductor stocks exposed to US growth. So okay, so that's one part, is the EM side. The CapEx one, before we get to the funding, because that's a really interesting story in itself. The CapEx is a really interesting part of that bull case I was talking about. So where could we see that the data centers where can we see this sort of virtuous cycle coming out? And one of the places is in this CapEx, insofar as you can make a pretty good argument that Google, Meta, Amazon, Microsoft, all these companies that are spending all this money on building data centers, and so much so that even Google sort of raised capital for the first time in forever. What were they doing for the last 5 or 10 years was making so much money they didn't know what to do with it. And they were shoving it in cash. They're doing share buybacks. They were just like, well, we've got so much money, we don't know what to do with it. Let's buy back our own stock, stick it in, stick it in bonds or whatever it is. And now these guys are actually turning around and spending that money on and so there's talk that of the US growth that they're probably providing half the US GDP growth or something like that from these ones. But there's the other part is there's this multiplier effect of when you're just grabbing the money, sticking it in the bank, there's no multiplier effect to that. But when you actually take that money and give it to people to build stuff and tractors to dig it up and equipment to do this and mining to get me more copper and all the stuff that goes involved in it is that well those people take that money and then they spend that money and then the next person spends the money and so you do get this positive multiplier effect which is probably driving a reasonable part of the next part of the GDP growth in terms of saying well these guys might be directly providing half of it but maybe some of the rest of it is actually coming from them anyway as that sort of multiplier effect happens. And so that's great in one part and sort of explains why the US economy is, holding up maybe better than it was, but it can go into reverse, if that when it does turn, it's probably a sign that it's going to come back further. But your bull case is, look, these guys are spending this money, they're not going to go broke, you know. Google at whatever it is, multiple trillions of dollars having to raise $80 billion. Maybe they'll raise $100 billion next year. It's not going to send them broke. They've got plenty of scope to have more debt. And if they're putting that into the rest of the economy, then well, happy days for everyone else who's sort of sharing the wealth a little bit. So yeah, so that capex side is definitely part of it. And the interesting part is, well, maybe the fact that the consumer's so weak is helpful for on the inflation front. Because if we had this booming consumer out there spending money and doing things and, stores wanting to expand and all that type of stuff, then all of a sudden, the tractor that's digging the data center might have been used for digging up houses to build for people or something like that. And so maybe there's a little bit of you know there might be this path that sort of leads through the bull path, which is weak consumer, weak rest of the economy, booming data center market, which keeps the multiplier effects keep pushing out into the rest of the economy. That keeps this thing roughly stable, and actually maybe inflation doesn't. It's still going to run high, I think, but maybe it doesn't get to the 4s and 5% that might have if we had a really strong consumer at this point in time as well.
Mm-hmm.
And so yeah. So, anyways, that's a bit of capex. Do you want to talk about either of those, EM or capex?
Just one little observation.
Yeah.
The Australian GDP numbers that came out was flattered by data center investment, right? So even in Australia, which is not performing particularly well at the moment, economically speaking, without the data center investment, the GDP number would have been a lot weaker, and in fact, we probably would have had a potential recession. So it's fascinating to me that even in less technologically developed economies like Australia, the demand for data center space is huge. But the point also is the data center operators can afford to pay top dollar for water and power.
Oh,
right?
Yes, absolutely.
Which immediately then puts huge upward price pressure on the very things that the rest of the economy needs, including households. So there is an inflationary pulse there too.
Yeah, definitely. And this is a part where, okay, let's deal with water separately. On the electricity side, we've spoken in several of the podcasts, is that, yeah, look, electricity it's really important to the data centers at the moment because they can't get it in terms of we can't get connected at the speed that they want, and it's such a small cost overall for what these guys do. Is that they could pay triple the prices or quadruple the price and they'd still be making plenty of money. So that's where that pressure on those comes from, and there's this weird thing going on in gas turbines in particular, which is one of the things that could ease a lot of the issues in the US. And I think I've shown you pictures in the past. I mean, there's trucks with gas turbines on the back of them that you can basically drive into these things and park them, or they're literally bolting aeroplane engines to the floor and to run the power for the data centers, just so they've got their own local power and they don't have to rely on connecting. But Yeah, so the because we had this massive boom in making gas turbines back in the 2000s, all these guys set up all these massive factories, and then demand fell off, and they all lost bucket loads of money on their factories. And so they're all looking at this, going, look, they know climate change is here. They know this isn't going to last forever. Do I want to go out and build a factory that I'm going to need to get a 20 or 30-year return on, that builds gas turbines for what could be a 5-year boom in needing gas turbines before they stop needing it, or more carbon taxes come in, or all that type of stuff like that. And so they're basically going, well, I'm not building a new factory for this. Yeah, I'll just sell my existing stuff out of my existing one at 5 times the price, and everyone else can fight over it. So there's that's sort of going on. Um, and then the water side is sort of similar in that, uh, relative to other factories, like if you said, oh, look, you say, talk about it, yes, it uses a lot of water, but, relative to, say, putting a cement factory in, or putting, whatever, some other manufacturing process in, it's not that dissimilar. It's not wildly different. It's more of a local problem, I guess, is what, from the water perspective, is like, well, yes, you want to put 10 of these things in an area. Okay, where are you going to get the water from? Where are you going to get the power from? Concentration type risks in terms of that. So yeah,
Yeah, and
lots going on.
the point, just to underscore, the inflationary impulse that could drive could be quite significant for ordinary people, right?
Yes, that's
Because
right.
the price per unit of energy is
Mm,
something they can afford to pay a lot more than ordinary people can pay. And
that's right.
I'm fascinated by this in the context of another thought, which is massive investment, capital investment means significant tax write-offs by way of depreciation, right?
Yeah, yeah,
And
yeah.
what does that mean? It means that actually those big companies may well end up paying ultimately less tax than people think they might pay, which then puts
Yeah,
more pressure
yeah.
on the public purse to be able to
Mm,
finance all of the stuff they're trying to do. So again, there's a big economic driver there that I'm not sure, again, a lot of people have
mm.
passed. Plus, of course, the interesting question is, what is the depreciation time frame for some of the chips and things that are being used in these things too? So, oh dear, it's
Yeah, and
it's a mess.
yeah, the depreciation stuff. I haven't got the charts handy, but that's the stuff we've seen so far lasts a lot longer than everyone had thought.
Mm.
And there are a number of people who are concerned out there and saying, look, this is a big issue. These things, this is what's going to, it's a whole accounting scam. I'm not in that path. I'm just looking at the prices, and they're genuinely published out there. There's published series of if you want to hire a 3-year-old chip or a 5-year-old chip, they're out there. You can see what the prices are, and they're still making reasonable returns on those. So yeah, so I'm not at the moment. Maybe the whole thing will finish and they won't, but from what I can see, there's enough demand out there for this compute power. Um, Although I will talk about some of that, because there's definitely been a change in the way people are dealing with it. But the demand for building these data centers still appears to be there.
Yeah.
Um, okay, so there's that. The funding part. So,
Mm. Mm.
so the funding is fascinating. So we've just had SpaceX pop on. We spoke about that last time.
Yeah.
They didn't raise that much money. So sorry, it was the biggest capex, biggest capital raise ever, I think. But it was 75 billion. So in terms of the overall scheme of, like, can capital markets handle another 75 billion? Yeah, sure. That's not a big issue. The issue with them is, if they're worth a couple of $1 trillion, and there's a bunch of shareholders who want to get out, that's the issue. So on day one, everyone's locked up. Everyone's locked up for the first 3, 6, 9 months. It's a gradual. It's sort of this. It is a weird one as well, in that there was. The stock gradually comes out, and the higher the share price is, the more stock can come out, and the lower the share price is, the less stock can come out. So if you said, "Oh, how much of this is coming out in a month and 2 months and 3 months?" It's like, well, tell me what the price is going to be, and I'll tell you how much is coming out. It's not clear, and that's sort of designed to keep the share price relatively high. Would be the cynical view of that, but if you're talking 12 months in the future and half the people want to get out, then that's a big amount. That's trillions of dollars we're going to need. Plus, Anthropic's coming on, and we can show you some of the numbers from Anthropic. Uh, we've got OpenAI is going to list as well. Um, there's and they've got sort of similar profiles in terms of this. You've got all the all the Googles and Microsofts and all those guys. Well, they used to be putting money into the market every year. So what we spoke about before, they were out buying stock.
Mm.
Now they're not. Now they're out there. Some of them are even selling stock and raising capital. And so the capital needs of the market are going to be very different. And it's worth noting that the number of floats and everything like that we've seen over the last decade or more have actually been less than the number of stocks coming off the market. And the amount of buybacks. So actually what's been happening is on a net basis, money's been coming out of the markets. Usually stock markets are there to raise capital and people pour money into it. And so, the last time that happened was sort of back in the tech boom.
Mm.
And so we are going into something that's going to be a different period where over the next 12 months, we're going to need a couple of $1 trillion to come out of other investments to stick into these new investments that are all listing. And is that enough to tip the market over? It's a question. It's probably, let me jump forward to while I'm talking about that, just to show you the earnings while I'm on that. Anthropic's come out, and this is their annual earnings. So this is the sort of they've got like a PDS. I can't remember what they call it. It's not the official one, but it's floating around the draft type version. But this is showing their annual revenue rate at the moment. And so January 2024, so what are we talking, 2.5 years ago, they were on zero. And now their annual revenue rate is 60 billion. And my interpretation of what Google just did to a whole bunch of their AI users, including myself, is that this number is just about to jump again as all these Google business users who Google just screwed are going to jump ship across to Anthropic. And so and they're making money, these guys. So we saw SpaceX coming out talking about losing $5 billion or something like that on the Grok. And here's Anthropic talking about making $1 billion worth of revenue in the latest quarter. And so there's look, that business is looking far better than I thought it would look in terms of this and growing.
Well, it's all about the cost of tokens, right? So if you look at now the amount of tokens you have to spend to run those AI queries that once were given away or very cheap, it's now very expensive. Right.
The crack dealers, they gave it to
exactly. They get you on, get you hooked, and then you got nothing to say. Oh, I got to pay.
Yeah, that's right. That's right. So,
unless you can run AI locally on your own machine or a version of AI, right? Now that's for me a really interesting tipping point. There will be a point where you can do quite a lot locally without needing to pay the tokens.
Yeah. So the way I would think about it, certainly how we've seen it at the moment is the AI that you can run locally is 6 to 12 months old, the equivalent of the AI from 6 to 12 months earlier. And so like the AI models that came out at the start of this year were a step change in terms of programming skills. And that's what really drove a lot of this growth was just it went from being, hey, this is a nice way of doing code completion. It means I don't have to look at some websites and I can copy and paste some stuff and makes me a bit more productive to shit, this thing can do this. I can just give it the specs, give it a proper spec. Here's the input, here's the output. And so you can now run that locally. And a lot of these are open source models. And so, so that the issue we're looking at for these is, if you want to say, oh, can you summarize this document for me? Or, can you turn this into a PDF or I don't know, whatever. There's a whole bunch of things that these things are perfectly capable of doing and the simple tasks. And so, what we've been doing internally is just separating a lot of our flows now. So rather than saying, look, we're just here's the model we use and we'll just keep using that or whatever, or we click between models sometimes, is actually a lot more around, oh, you know what? I need to do something really complicated. Let's go and use one of the Anthropic, top end models and costs the most, but it does the plan properly and gets it right in first go. And now I just need to do a bit of simple stuff that this thing's already mapped out for me. Oh, right, now I'll go use the ChatGPT one to do that and iterate. And now I need to do a bunch of whole, quite simple, relatively dumb stuff. I'll just use a free one that I'm running on my computer. And so there's that's coming. The Chinese ones, which is sort of why some of these Chinese ones, like they're really interesting in what they're doing and stuff like that. But for a large part, they do stuff and everyone else just cheats off them if they're anything good, and if it's no good, then they're sort of they seem to sit perennially behind. Um, and the question is, would I prefer to run a Chinese one that might be, 20% better than the ones I can have for free on my PC, or or I just want to run the one for free on my PC, and when I need something good, I'll use the Anthropic one or one of the others. And I think that's where most people are ending up, is that there's just a slight concern about where the Chinese ones might be used. And the other one is so we've seen the price prop up, but it's worth noting Meta, who I always thought of as a bit of a last in case, but, interesting one. Some of their models are actually looking pretty good. So this is a one from, who does this one? Semi-analysis, sort of talking about trajectories and how what they've improved and stuff like that. And they're thinking the meta models are going to be some of the best ones by the end of the year. And so, anyway, in terms of the compute and stuff like that they're doing. So, I think there's betting on, the other thing is that's this idea that betting on which one's going to be the best is difficult for these ones. As much as Anthropics looks great, everyone, and myself included, that I know doing on this is now designing models around saying, well, no, my flow needs to sit here. I don't want to be reliant on Claude Code or ChatGPT or whatever, because they might be the best one in 6 months' time. Or and the cost. I want to run whatever's most cost effective, and so it's going to be they're making lots of money, but it doesn't seem like it's going to be a really high margin business for them in the long term. But yeah.
So the interesting question is, to what extent is this all built on very shaky ground? In other words, will they then change the pricing point? Will they change fundamentally stuff that they're doing? Like Google's, they've moved the goalpost dramatically, right? We're going to see, I think, a lot of this ahead. So it's not a stable environment on which to build a business, is it, really?
No. And it's also, but the flip side is it is a bit of a winner take all thing, or winner take a lot in this. And maybe there'll be 3 or 4 big ones that are out, can afford to have all the top end programmers and all that type of stuff building these. And there's these open source models that are sort of following a bit behind, but they're there. And so it's this question about saying, are any of these big players going to go, no, you know what? This is too expensive for me. I'm out. I'm going to run what somebody else is doing. And so I think Apple did that very early in the piece. So just like, no, we're not going to play. I don't know whether any of these other guys are going to do that. It's sort of the question about, they all just going to keep trying to, with a view that, look, if I can become, the next Google, so to speak, what Google did in search, if I can do that in AI, then there's plenty of value there, and so maybe I'm willing to risk the company to try and do that. And so, yeah, they're all spending bucket loads of money. When are they going to stop spending that money? That's a very good question. And the other part is, that you got to keep in mind with all of this is the economics for companies using it, though. It looks pretty bloody good. Like, I mean, 2 or 3 years ago, there was lots of cases, and even a year ago, you can make lots of cases to say, look, they're spending the money. Are they getting the returns on it? Is it worth it? All this stuff like that. From what I can see of real world companies using this, there is genuine cost savings in people's IT departments. There's genuine cost savings in their compliance departments. A lot of the middle management type stuff. If you're spending $10,000 a year per employee on some AI, but you get to cut 20% of your workforce, it's like, man, that's the numbers we're talking about spending per person are so small relative to salaries. It just does not take much. And so, there will be, this is going to go overboard and it's going to get too big. And at some point there'll be some sort of crash. But is it happening this week or next week? It doesn't look like it. Is it going to be, could it be 2 years away? Sure. Could it be 3 years away? Absolutely. Like, there's this question about how much bigger can you get? If you could have looked at the AI, sorry, the internet boom in 1998 and said, this is crazy. A lot of these companies don't make money. Why are they worth so much money? You know, this is all, it's all going to end in tears. And you're right, but in the meantime, the market tripled and or quadrupled, and then came back to the level where you decided to get out. And so, I think if you think you've got sort of, perfect foresight into where this is going and where it's coming from, then absolutely, jump in, jump out. But I think there's a risk for me is that while we're seeing this extreme earnings growth, yeah, we need to be really careful. We know what we need to be watching is, are there any cracks in that earnings growth? Because when the cracks appear and that starts to become a bigger story, that's when we need to be worried about where the exits are. But if there's another 2 year runway and it spreads out to other sectors because of that multiplier effect, then this could go for a considerable period of time.
Other observation, of course, if you're buying the index and you have ETFs on the index, a greater proportion of the index is being propped up by this AI story at the moment, right? So
Absolutely.
you may actually not have a very robust risk spread despite the fact you're buying the index.
No, that's right. Luckily, Australia doesn't have much of much in the way of exposure to these, so that's where it's why it's underperforming in terms of the stocks you're getting. But yeah, so it is and the other thing to keep in mind is that even when you look at the sectors they usually talk about is the GICS sectors, is that Google's not in the IT sector. Is Amazon in there? I can't remember whether. I don't think Amazon's in the IT sector. Apple's not. Like, you go through a lot of these companies that are sort of peripherally involved, and you're like, and Meta isn't, and you're like, well, actually, that's in a completely different sector. And so, you've got to add some of these together, and yeah, you can pretty easily end up with close to 50% of the US market.
Yeah.
And the US markets of the world market is 70% of the world market. And so of the global market, it's probably low 40s, I think is what you could pretty easily end up with, saying, it's a 40 odd percent of the global market is effectively some sort of bet on AI.
Yeah. And even as you said earlier on, in emerging markets,
yeah, might be even bigger in emerging markets.
I think it probably is. If you do the calculation on the Kospi at the moment, it's pretty much all that. The same also if you look at the one in Hong Kong as well. A big footprint. Right?
Yeah, no, I'm saying if you took an entire, if you said, oh, I want to invest in emerging markets as a whole asset class,
Yep.
Because you add in those the three big ones, TSMC, Samsung, SK Hynix, gets you whatever, a huge proportion of the index. And then you go through and you go, well, actually, when I look through the Chinese ones, that makes up a huge proportion of Tencents and Baidu's and all these ones like that are all, up to their armpits in AI and driverless cars and everything like that as well. You might end up with a quite possibly you've got a larger proportion of your portfolio in tech than a developed country would.
Absolutely. Now you said something quite intriguing, which was, but it's not all about the AI tech story, right? There are some other earnings areas as well. I think we've probably explored the AI related things, unless something else you want to talk about, but I'd be interested in some of these other sectors as well.
Yeah, so I've got a chart up just showing now this is a little bit out of, this probably, well, when I say a little bit out of date, it's like a month, 2 months old probably. I know, actually 3 months old at the moment. So it hasn't changed that much. But so this is just showing you how much of the performance, the red dots, what the sector is up, and then how much of that came because the earnings increased, and then how much of that changed because that's the yellow line, and how much is the blue line is because the valuations got better. So you can see in the energy sector, the valuations got worse. So i.e. they got cheaper, these stocks, but the earnings, was up almost 50%. And so energy sector is one of those ones, meaning that hockey stick growth we saw. That's one of the reasons. And so you go, well, okay, that's not high quality earnings. That's here because there's an energy crisis. Maybe it'll stay high. Maybe there'll be a massive energy crisis, but that's not a good thing for the market. But industrials are there as you can see. That's sort of that third one. They're growing their earnings on aggregate. Real estate, communication services is mainly Google and Meta. But the materials sector, is out there growing earnings. Like you just look at it, it's not like every single sector has had earnings increase by more than zero. Yeah, none of these sectors are going backwards. So while some of them are a bit tough, and you might look and say, let's say the healthcare sector might only be growing at 3 or 4%, but it's growing. It's not going backwards. And so, uh, can we start to see that the spread out from these into other sectors or even if is it just enough that multiplier effect I talked about that capex spreading out to other sectors, is that just enough to keep these other sectors from falling into a big recession or big earnings downgrades? Maybe. And so, yeah, it's earnings. That's what net effect is. What's going to stop this market from rising? When earnings stop rising. And
of course, we have the new earnings round from the US starting this week. We've got the banks reporting and a few others coming through this week as well, right? It'll be very interesting to see. I think quite a few of the banks will be making quite a lot of earnings thanks to these big floats and things that they've been involved in recent times.
That's right. And surprisingly, all the people who did the SpaceX float have a buy recommendation on it.
Yeah, funny that, isn't it? Yeah. Nothing to do with nothing. And now in Australia, of course, the banks are more exposed to the mortgage market, so maybe the Australian banks are somewhat overvalued relative to the US banks, which is another little observation in terms of how different the Australian market is to the US market. But the truth is that the exposure that people have had to the US market have done very well over the last 2 or 3 years. Similar exposures to the Australian market, not done so well.
No, that's right. And so, this is this question about, okay, so the Australian market is largely intermediaries. So whether you're a bank, you're basically you're basically taking money from somebody and lending to somebody who's hopefully doing something productive with it. You're not actually doing anything else. You're
buying mortgages, you mean? Buying mortgages, houses.
That's right. Yeah, exactly.
That's really productive.
But and then we've got real estate companies that basically just own property and sell it to somebody who's hopefully doing something productive with it. I own a building and hopefully I've got tenants that are actually making stuff or providing services or whatever it is. There's toll roads. There's basically the toll road's built. All it's doing is collecting money on people that are going past, hopefully doing something electric, something innovative or productive. Gas pipelines, electricity networks, all those things which are sort of ticket clippers or they're not actually doing anything innovative or new. And so, and Australia has made up a lot of those companies.
Yep.
And so far more in Australia than what you get elsewhere. You're sort of 60, 70% in Australia and, 10%, 15% elsewhere. And so the question is going, okay, what do I want to get access to? What are the sectors I think are useful and all that type of stuff? And while resources, there's this idea that AI stuff is going to create all this demand for resources. Look, I just don't buy it. The amount of copper needed for these things is a lot when you look at an individual one, but we just don't have that many of them. Like it's not the same as when you're in China building out, millions and millions of new apartments that need to get done. You're sort of like, well, the equivalent of a couple of these things sort of adds into a data center. It's just not the same. It's not on the same scale. And in a big picture sense, when you look at even the electricity needs, say for these data centers, like if you go, I can't remember, I think I saw something today that was like, it's going to add 12% extra to Australia's electricity demand by 2040. And you're like, man, it's 1% per annum. Like, can you grow something by 1% per annum without it? Yeah, you can. There's no problems at all. The issue is they all want it right now because they all want to make, every day that this data center isn't built, they're losing money. And so it's the rush rather than the, is this possible to do this over a longer time frame? Is like, yeah, no, I don't see any real issues with the longer time frame getting there. It's a question about, the next 12, 18 months while there's this real scarcity and just demand for things that aren't there.
Very interesting. And again, I want to highlight, if you're thinking about building wealth for the long term, the growth rates investing in Australia relative to growth rates in some other markets have been and probably will continue to be very, very different.
Mm. Yes, I'm definitely on that part. Look, we have, I don't know, two and a bit times more, well, more than double the amount of international equities we do in terms of than Aussie equities at the moment within our portfolios.
Yeah.
And yeah, it's one of those ones where this has been changing over time. 20 years ago, 30 years ago, the consensus was, oh, look, you want lots of Aussie equities because you're going to retire in Australia and that's where you need to, whatever, that's where you need your assets. But there's the cynical view is, well, it was actually pretty hard to buy international equities 20 or 30 years ago. And so that's why everyone said you need all these Aussie equities. And then as we go over time, is like, well, your international has given you a much more diversified portfolio, better growth. And you know what? We all buy lots of stuff from overseas all the time. Like we don't make cars in Australia anymore, and we don't make any electronics in Australia. And there's all this stuff that we're going, well, you probably do need. You're watching movies. Most of the movies you're watching, I'm guessing, are not Australian made, and so all this stuff is you want foreign purchasing power in case the Aussie dollar does drop over time. And so it's like, yes. And so, the consensus has been more and more international stocks in your portfolio. And we've certainly been following that. And we're considering as well, possibly even changing some of our mandates just to say, well, actually, maybe from what, it's been 10 years since we started this, maybe and things have moved along, maybe we should be able to have a little bit more international and maybe our benchmark should no longer be as much Aussie as what we've had in the past.
And that's true for superannuation as well as those outside superannuation?
Yeah, absolutely. So the superannuation companies have definitely been moving in this direction. Yeah, there's where they've been moving most though in the last few years is into unlisted assets and private equity, and that's where I think there's some. We stick to all the listed stuff with a view that look, in unlisted stuff you can mark your own homework. The pandemic comes around and the person who owned a listed airport all of a sudden saw their airport fall by 50%. All the unlisted guys sitting in the super funds went, no, I think my airport's still worth the same as what, there's no one going through it anymore, but, still worth what it used to be worth. And so, so you can report better performance when you want to, or you can adjust your performance a bit more to that type of stuff. And yeah, it's all well and good when you're doing it and you're the one drawing down. But if you're the one drawing down when they've overpriced their airport, that's great because I get to sell my shares to the person who's just put his salary in. But if you're the person putting your salary in, you're like, just a minute, why am I paying twice as much to buy this airport as what I could have bought it for on a listed market? So anyway, so that's an issue. But I do think there's some larger issues facing that private equity sector and the whole private debt. And that is one of the blow-ups that's well worth watching. And will it come? Won't it come? Who knows? I just know that private equity sector is way bigger than it used to be. It's grown dramatically. It's going to have some massive wins on these Anthropics and SpaceX's and all these ones like that. They can trumpet a few of them. But there's a whole bunch of them that bought a lot of software stocks that are no longer worth what they used to be worth. And there's a lot of them that are now reaching sort of the end of their period where, the way a lot of these do it is they go, oh, this is a 10-year fund or something. And we buy 20 companies at the start. And then as time goes on, we start selling them and giving the money back. And by the time you reach your 8th and 9th year, you're like, yeah, I started with 20 companies and I've got 5 left. Why have I got 5 left? Well, I can't sell those to anyone because nobody wants them anymore. And so maybe, the question about what they're, some of these then start turning them into, oh, we're going to turn this into an evergreen fund. We're going to roll those into a different fund and hopefully they'll be better in another 10 years time or something like that. But A lot of super funds have got exposure to that. And so if you do see blow ups in that, there's super funds I think have very much expanded in that area in ways we hadn't seen over the prior
Yeah, and
decades.
disclosure is still very low. And it's interesting, the RBA came out very recently warning about private equity and the potential
Mm,
risks as well. So it's becoming more and more a topic. The extent of it's not fully clear. What they're invested in is not fully clear. What the risks
mm,
are not clear and not reported. And so it's
mm.
this massive black box which is growing. And whilst magically you might get returns out of it, nobody quite sees what's in the box and how those returns are actually being engineered and what it does for the people who are still left.
No, I can tell you what we do know is they do generate very good fees, Martin.
Yeah,
That's the
funny
one we
that.
can. Yes. So, and this is the part where when the private equity sector's, whatever, 2% of the global world market cap, and they're, so you go back 20 years and they're this sort of, small sector. And what are they doing? Well, they're doing the stuff that the stock markets don't really want to do, or too risky, or whatever it is, or they're just special situations. And you need patient capital, or it actually needs some work to turn it around and stuff like that. And so you get these situations where it's like, okay, it makes sense why these guys made these returns.
Mm,
And then you go, okay, now the sector grows by 10, 20, 30 times bigger or whatever that it used to be. So now what are you getting? Well, you're getting pretty much what you get in some of the listed markets. The differences are in a listed market, you buy an ETF or you buy a fund like ours and you're sort of paying, somewhere between zero point 0.1 and 0.5% or 0.6% or something like that. In these things, you're paying 2% straight up, almost guaranteed. Then there's all these extra things where the private equity one's providing consulting services to sit on the board. And, there's all these extra bits where all these other fees that they're charging these companies that you don't see. Oh, we did a listing for it. And so we're charging this fee and that fee. There's all these extra fees bundled in around it. They're making far more than that 2%, notional amount. And you're saying, well, just a minute, I've basically got the same exposure I could have got from the stock market, but just with higher fees and a whole bunch of related party transactions that who knows whether they're going to be helpful for me, but I know they're going to be helpful for the private equity company that just did them. So yeah, I think there's the RBA is right to be concerned
yeah,
about it,
yeah.
and not don't want to disparage all um, private equity because there's
Mm,
some great stuff they do that won't be done by the markets.
yeah.
But I think the sector's grown so big that now they just have to buy whatever they can. And that just means that a lot of their reason for being just disappears into yeah, into
Well,
that fee part.
the question is, has it now got to the point of too big to fail? And if so, what are the consequences?
Yeah. Look, I think the benefit is there's probably not as much debt. Well, there's probably not as much leverage within the banking system to this.
Mm,
There's probably a bit. There's probably more than what we think there is, but it's probably more caught up into okay. So you've given some private equity, and sorry, the capital is also not as is probably not as urgent or not as, it doesn't need to be as liquid. So I've given some fund $100,000 for 10 years with the hope that, my 100,000 will be 500,000 by the time they give it back to me. Um, well, it's pretty hard for me to argue that, oh, I really needed that money for my retirement. It's like, well, what did you give it to them for 10 years for then if you
yeah.
didn't? So, so there is the types of people who have invested in this are probably more likely to be patient with the capital. I do note that a lot of the issue you probably have in some of these, which will end up being bigger than what is realized, is there's a lot of private credit ones, and it's a part about, well, I own some private equity thing and that needed some debt, and so I got it from my private credit one, and they didn't look as closely at the terms and conditions because, well, we're mates and we, whatever it is, and so we're all trying to help each other, and maybe they're lending money they shouldn't have lent, and that part that could be an issue. And I do know within certainly a number of private credit firms, private credit ones, they are maxing out their withdrawals and have done for some time. So what I mean by that is a lot of these private credit funds are they basically sell them as okay, you're in this, you're locked up until we get all the money back. We've lent it all out, And if anything goes wrong, you got to wait until the money gets back. You can't get your money out. Is the sort of terms and conditions you've signed to, and the wink wink nudge nudge as they sold it to you was, oh well, we're going to do 5% per month, so if you ever do need to get out, you'll be able to get out. Don't, this is what you're signing, Martin, but don't worry about it, because if you ever do need to get out, we'll get you that 5%. Now these things have been maxing out, well, not all of them, but a lot of them have been maxing out that 5% for the last couple of months at least, where they're just like, and at some point they'll just go, well, actually we just can't do this anymore. And they'll just go, well, we're locked up, now you're waiting for us to get rid of sell the loans and give them to someone else. So there's there's warning signs happening in that market. Is it ready to all tip over? And is it sort of some big subprime crisis behind it? I don't think there's the same amount of leverage. But could you get enough of a crisis to tip an economy into a recession that might not have been into a recession? Yeah, sure. And if it happens in the wrong sectors, and there's some high profile data center blow-ups and people decide to stop doing data centers, and I don't know. You can certainly paint pictures as to how it could all turn into something significantly bad. But my expectation at the moment is the data center stuff looks like it's all full steam ahead and being largely done by people who can afford the capital. And the ones that can't, OpenAIs and Anthropics, are raising money to do it, and will probably get these raised away from buoyant equity markets. And there'll be some sort of mini rolling crises happening in private equity and private credit.
Just the point there, you've linked very nicely back to the earlier conversation about the AI story and data center story, right? Because the private equity story and the AI story is also quite interestingly linked, right? So it's all part of the same sandcastle.
Yeah, that's right. There's definitely been lots of lending in that part, and and it's the interesting one with that, where they'll, it might be that you've got somebody setting up a data center, and he's raised some credit to set up his company and do all that type of stuff like that, and maybe there's a mortgage on the land, and maybe there's there's effectively what trade finance on the chips that are in there. And so at the moment, everything looks fine. It's like, well, these chips, you can see that, it started being worth whatever, $500,000 for this thing. And over a 5-year period, it'll fall back to $100,000, and then maybe it's a write-off, maybe it isn't. But there's sort of a path you can follow. Now, if that suddenly takes a big drop and the value becomes less, then then that there could be multiple levels unraveling at the same time. I don't think that's going to happen, but it's worth noting. So I mean, and actually, that was reminded me of an interesting story from Intel. So Intel's had a great price performance as well, but it literally had chips which it had written off, because it was like, built these chips, nobody wants to buy them. So we're trying to sell them. They're dud chips. Nobody wants to buy them. Everyone else's is better. We've written them down to zero. And then they came back last quarter and said, hey, you know what? Those chips we wrote down to zero, because nobody can find chips now, everyone wants them. Well, and so we've gone and written them back up again, and we're selling them at inflated prices. And I guess that's I sort of always want to leave that as a bit of a microcosm of this market, of showing, the stuff that was so bad that, that wasn't good enough, that they got rid of it, is now the stuff that they're like, well, now we can sell this at a markup to its original price. And while that's not a sustainable business model, it is a sign of how big the demand is for this stuff at the moment.
Absolutely. And of course, the US government, I think, has an interest in Intel as well. So it's all part of that story. Now, one last thing to touch on before we close out tonight. The CGT changes are sort of morphing and emerging now in Australia. One of the things that have come up quite a lot in the journalistic comments on the mainstream media is it favors ETFs against individual stocks. I've been scratching my head a little bit around that to say, is that really as true as the way that the story is being positioned, or is it actually the people who actually are supporters of ETFs and maybe owners of ETFs who are preaching the gospel of, no, you should switch to ETFs now? What's the true story on this one?
I think there's more of that. Look, the interesting thing with stocks is if you look at portfolios of stocks over long periods of time. So let's say you took the ASX 200 or something like that, and you said, and you looked at where did you get your returns from? It comes from a very small number of stocks. So, um, the top 20% or top 10% gives you most of the return, and then the next 10% gives you a little bit more. By the time you get down to the 50th percentile, so basically the median stock, it's probably losing your money on a capital basis. Maybe they're paying dividends and stuff like that, and it ends up being, you're basically flat on the whole deal. But you probably half your stocks are probably down over the period on a capital return basis. And so if you're managing your portfolios, say you've got an index like a direct index, so how we do it in our within the fund that we've got with the Walk the World Fund, is that the stocks that are falling out the bottom of the index have almost by definition gone down, and so they're generating capital returns. The stocks that are coming into the index are the ones that are, well, you don't need, they're sort of popping in and you're just buying them, so you're not actually selling them. And the ones that at the top of the index, well, you're never selling those ones because they're the top stocks in the index. And so if you're managing the individual securities, then quite often you can manage to create tax losses. So as an example, let's say we've got this direct index, you've been adding money to it over time, and SpaceX comes in, and you're like, oh, okay, that might be 2% of the index. I'm going to have to sell a few stocks, a few of the bigger stocks in order to make room for it. You're like, oh, okay, I do have to sell my Nvidia that I've got in there that's up 1,000% from when you bought it. Yeah, but if we've been reinvesting dividends and reinvesting, if you've been adding more money to it, stuff like that, we've got stuff we bought last week because we've got a dividend and it's down over the last week. And so we can sell that one, take capital loss, and use that money to buy the SpaceX and not have to realize those capital gains. And so on a diversified portfolio that's been run properly and you've got the tax stuff behind it, you should be able to, like, this is there's no loss from this. There's no reason why you'd want to be in an ETF or not in an ETF. Whereas if you had that same issue in an ETF, or let's take the example of you've had this direct index running along, and now now you want whatever it is, 20 grand to do to help you with a renovation in your house, and you want to sell some stock. Is you go, okay, I can sell all of the stuff I bought recently. I can sell a lot of these stocks that are all down and realize capital losses, and I can get out of this thing with either very small capital gains or possibly even capital losses I can take when I sell that money and use it to do my renovation. If you're in an ETF and you're in that situation, and the ETF's gone up by this, you can't choose to go, oh, let me sell these ones that are down and let me sell the ones that are, and get rid of the ones that are up. The ETF's up, it's up. You got to pay the capital gains on it. And so if you own the individual shares, you can be a lot more selective about what's coming in and going out. And especially if you're going to be adding more money to this, you're like, yeah, look, I'm adding whatever, $500 a month to it. I need to take 20 grand out for my renovation, but then I'm going to start my $500. You can just go, oh, okay, let's tip out these stocks and, do something without a capital gain and then just replace them with the 500, just adding $500 a month, and gradually that'll replace the ones I've taken out, and I'm back to the start. And I've had a much better tax experience than owning an ETF and having to take that capital gain, pay tax.
So, but the implication there is you have to have the right platform on which to do this, right? You need to have the transparency and the granularity to be able to make those decisions. And
exactly.
my concern is that many of those platforms that are out there obliterate all of this stuff, which means you could end up paying a higher tax than you need to pay.
Yeah, that's right. So what this is a lot about. So when you're sitting outside the superannuation thing and you're investing in your own name, so we have the option where you basically go, look, what do you want to do with your tax? Now, by default, we minimize it. But if you want to maximize it because you're like, oh, actually, you know what? I'm not working for the next 12 months. Give me all the capital gains I can take, so I can get them at a zero tax rate. Great. You can choose to do that with all the tax lots. So you can just basically, change your options within it. But by default, you want those things that just that I've bought Nvidia, 15 times over the last 3 years. Don't sell the ones that are up 1,000%. Sell the ones that are flat or down because I bought them last week, or the ones that are only up 20% because I bought them last year. Those types of you want that sort of built into your into the platform you're doing, not the ones that a lot of the ones will just commonly go, first in, first out or whatever. It's like, yes,
Yeah.
we will sell the ones that are up 1,000%. And that's like, yeah, you
And
don't
I
want that.
remember having a squabble with my accountant years ago about this very point, because the way that they chose to compute it was just what you said. But actually, the real way to do it was actually completely different, and it completely changed the tax story. But they didn't want to do it because it wasn't the way that they normally do it.
Yeah, that's right. Well, and it can be harder, and this is one of these benefits of, and where you're seeing, we find that having built this stuff in the last sort of decade with technology that you've got, you can build it all in as you set it up. A lot of these super funds were set up in the 1980s,
Yeah.
and they were basically, the idea was, actually this stuff's really hard. Let's just bundle everyone all into one big bucket, and then we'll just deal with everyone, and there won't be an individual, and everyone's tax position gets mixed up. Because that's the other thing within the super funds you miss is that, so if you've got your Nvidia shares there and you're like, okay, I'm adding, I'm not subtracting. I just want more. I'm getting more and more Nvidia shares every period. But there's a whole bunch of people who are retirees, and so they're going, oh, I need my $10,000 for this month, and I'm taking it out this week. Martin, you're adding your money in a week and a half, and so the funds out there going, well, I've sold my Nvidia. Now I've got to take the capital loss on that. Sorry, take capital gain and pay tax on it. That gets spread amongst everyone. And then when Martin comes and buys more next one, so you lose your tax position gets mixed up with everyone else's, and you can end up paying more within the super funds than because of that bundle. Where the later the later you've got the newer stuff is where it runs it separately can be a lot more tax effective.
And so the conclusion that I have from all this is that actually the changes to CGT means that the sophistication of the platform that you're actually investing on becomes even more important.
Yes,
right?
absolutely.
And I think that's the message that I want to leave with everybody tonight.
That's CGT.
Yeah. The CGT thing is worth getting to grips with, but you need to understand the platform and the capabilities of the platform you're with, because there are big differences in terms of the tax outcomes depending on precisely the way it actually works. So it's much more complicated than it used to be, but it doesn't mean it's not necessarily still worth investing in individual components and stocks. The story is not just jump onto an ETF and that'll be solved. No.
Yep. And the other thing I'd throw, which is another common one I see out there that's worth debunking, is this idea that, because of this happens, you need to move into income type funds. And so the issue with that is there's the part of that makes sense is to go, you know what, if I'm in an income fund that's earning 6% and I've 4% of that is a dividend because I'm in pension phase now, that's tax free. Now the 2% that I'm earning, well, that's going to be below inflation. The 2% capital gain is below inflation, so I'm not paying any capital gains on that. So here I am getting, 6% return, not paying anything on the income because I'm in pension phase, and not paying anything on the capital gain because it's below the inflation rate. Happy days. He's like, well, yeah, but if I could have been earning 7.5% in a growth fund or 8% in a growth fund, then I would have paid far more tax, but I'd have far more money. And so it's this part about saying, well, do you want to have less money and be in a lower growth fund, or do you want to have more money and pay some tax on it? And so, if you want less money with it and not have to pay tax, then go with that low growth fund. But if you want more money and have to pay some of it back, but you still end up in front, then so don't necessarily treat this as I've got to be in these low growth funds.
And so if you start making decisions purely from how do I reduce my tax payments, you're asking the wrong question.
Exactly. It's how do I maximize my after-tax income? That's what you want.
That's the right question. Yeah.
Yes.
Damien, thank you so much. I think we've covered some great ground tonight and very useful thoughts too there. Links and things below for those who are interested in the World platform and Nucleus Wealth. The platforms that we're talking about here are very flexible and agile, and in the current environment, more important than ever. And I'll look forward to getting you back on, it's probably the first Tuesday of the next month, when we'll start to see the results coming through, and we'll be able to know whether, in fact, the reporting season is going to hold together or whether it's going to start wobbling. So should be an interesting conversation then.
Excellent. Looking forward to it, Martin. See you then.
Thank you. Take care. And I'll take you offline and close the show. Thank you. So there you go. Very interesting conversation with Damien, as always. Links and things below. And just to say that next week, Edwin is coming on for a live stream. He's got something he wants to share in terms of some development work that he's been doing with some colleagues, and we're going to explore that. So it'll be quite interesting. And so check that out. Of course, recorded shows are made each day of the week and posted, so check those out too. And before I go, the doggies are here. They've been quite quiet. So there we go. There's the dogs. So it's time for the next walk, which is my next task. So thank you very much. Have a good evening. Take care. Keep well. I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off. Take care.